our productivity in building has fallen behind. We really have created a skilled migration system, but for some reason forgot to bring the skill of building to build enough homes for the people moving to Australia, of course, the people being born here, and the lack of deaths of people. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into a bit of pie. I don't know if we'll do the complete pie, but we're going to talk about where Australia's at, some of the interesting data coming out of economics. Certainly, we'll have a look at the market cycle, tackle where supply is, and also talk about some of the relativities around population. So should be a good show. Welcome back, regulars. Play the program in double speed, get your life back. All the episodes I've done are lessons on real estate. So, feel free to dart about, go and find some education on real estate. And of course, as I kind of allude to, the big plug, the plug of the year is the book. I should have an audio book coming at some point. Team at work are trying to help me with that. The Australian Property Game. It's available on Amazon. And there's all sorts of things you can learn. You can learn the law of the few, the stickiness factor, the power of context, all in the Australian Property Game. There's whole bunch of good information in there on how to be a property investor. So if you're starting out, might just be the place for you to go. But let's do it. Rafi's out the back. I can hear him. He's snoring away like a little beaver, little bear. But he'll probably pop in and you might even see him if you're a YouTuber. He may even pop in and see what I'm doing. But population, let's start there. I think it's a big conversation piece. There's obviously lots going on in that space. And of course, Australia is a growing place. It's growing very, very fast. And for a lot of Australians, that means that their share of the economic pie is dwindling because GDP per capita is kind of going backwards. And of course, GDP per capita is effectively your piece of the Australian pie. So Australia's kind of divided on this one. You've got a lot of people who want to slow down immigration, and then you've got other people that really embrace the fact that Australia is a huge place, and bringing more people here grows the economy. It creates more taxpayers. But really, if we're really specific about it, Australia's business model is services. So you've got to bring more people in if you want to sell more services, and it becomes a little bit of a Ponzi scheme at times. Bring more people here, sell more houses, start more coffee shops, that kind of vibe. But there is today one birth every 1 minute and 48 seconds. One birth every minute and 48 seconds. There's actually a death every 2 minutes and 48 seconds. So there you go. We're kind of growing our babies faster than we're passing away. And of course, that in itself is one of the reasons why we tend to bring people here into the country to create more taxpayers, because we are effectively living a lot longer. We have a new person arriving in Australia every 54 seconds. Wow, that's huge. Every 54 seconds, there is a new arrival. And they're arrivals, people coming to live in Australia. However, we also lose people. One Australian residents leaving every 1 minute and 54 seconds. So people leave, people come, but the overall population increase when you account for deaths, arrivals, departures, and new little sneaky babies, the little baby boom. Australia's population increase is effectively one person every 1 minute and 16 seconds. Now, you can imagine that is growing the population quite rapidly. And according to today's statistic at the time of recording, Australia's population is 27,664,489 people. But as you can imagine, if the overall population increase is a person every 1 minute and 16 seconds, it's very difficult to build a house in 1 minute and 16 seconds. And so, of course, if you're going to grow your population that rapidly, it's going to put a lot of pressure on what happens down the track. The leading measurement is people. The lagging measurement is effectively properties. Now, according to data out through the ABS, Australia's population grew by 484,000 people, effectively between September 2023 and September 2024. Now, I know that data is a little bit retrospective, but it's a good, I guess, way to look at data. You kind of sometimes have to look in the mirror to see the full picture. And of course, 484,000 people over the year, September to September. That's a lot of people. That's really enough people to start a new city. Some cities around the world are 480,000 person cities. Here in Australia, your Hobarts, your Canberras, your smaller kind of primary kind of cities are 484,000 person cities. So we grew by the size of effectively a Canberra. And I guess the argument is, should we continue to grow at that rate, or should we just peel it back a little bit, and that may soften property values, that may soften the economy a little bit, that may make it, more livable today because you're sharing Australia with less people. And of course, one of the challenges is just an aging population and taxpayers at the bottom of the funnel. And so there's no right or wrong, there's just economics behind all this. But the annual growth rate is close to circa 1.8%, which by world standards is pretty strong. It's pretty strong. And Australia is just a growing place. One of the challenges in Australia is the fertility rate. Babies born per woman is now at around 1.5. And so 2 people have a baby, 1.5 is recreated. And so we're not replacing ourselves through births. So overseas migration or migration into Australia is one of the ways to solve that. And of course, that tends to be a piece of legislation which rewards property investors, because obviously the more people, the less property, the principle of scarcity, you get effectively higher prices. And we can see that it's not spread equally when it comes to population growth. In fact, places like Tasmania get very little population growth, just 0.3% annualized percentage growth in that area. The Northern Territory, it's pretty hot. There's crocodiles. There's strange snakes. It's, balmy, but it only gets a 0.7% annual percentage growth rate from a population standpoint. And then you've got sort of states like Queensland, Victoria, and WA, which are getting growth rates which are exponential. Western Australia, 2.5%, Victoria, 2.1%, Queensland, 2%. And so you can imagine that it can feel quite congested at times in those places because more people are piling in. I know I used to run a property investment tour in Southeast Queensland, and it was, 5 years ago, it was very easy to get around. Today, that same tour, I have to be very, very mindful of just how long it goes for because of the afternoon traffic and congestion in Southeast Queensland. And all of that is because more people are choosing to live there. More people are choosing to live in Victoria, a annualized growth rate of 2.1%, Queensland 2%, and Western Australia 2.5%, which is mind-blowing. Western Australia is going through a huge rate of population growth. So all of that population increase creates a narrative and a reality that real estate is unaffordable. And if we look at affordability around real estate, really you can link it to Australia's population growth. Now, in the early 90s, the government of the day and both sides of government sort of forecast that down the track there's going to be an aging population and decided to really change the migration policy of Australia, basically creating a skilled migration concept and really opening up Australia to much of the world through education. And today, our education through our universities is one of the biggest industries here in Australia. We charge lots of money to learn here and really create a process of where a stepping stone student can start through education to eventually come through the funnel to live here in Australia full time and become a resident. And of course, if we were to track the affordability ratio before effectively Australia's, most, modern version of migration. Australia's had eras of migration. After the Second World War, there was a lot of migrants that moved to Australia. In the 70s, you had things like the Vietnam War end and more migration. But for the most part, if you look at the actual graphs of migration, it didn't really take off to the levels of where we are today of effectively, hundreds of thousands of people coming to the country every year until the mid-90s. And really, it was an economic principle. It became a principle of treasury. Population growth is not a principle of effectively anything else but money. And though Australia is a very multicultural society and, a very safe place and a very beautiful place, really the principle of population growth is linked to the principle of money, not to the principle of multiculturalism. It's effectively a fugazi. So if you look at, for example, the affordability index, where you measure basically house price versus income as a ratio, what wages people take home versus what it costs to buy a home. You can look at CoreLogic stats, Coality, AMP, ABS. And really up until the 90s, going all the way back to the 1930s, it was a little bit more affordable during World War II. But if you go back to effectively 1933, to buy a house in Australia was 6 times your wages. In 1981, it was 6 times your wages. In 1991, it was 6.5 times your wages. In 2011, it was 10 times your wages. And of course, today it is circa 14 times people's income at an Australian level. Now, of course, there's more affordable places than others. There's areas which are extremely affordable today, but are they connected? Is it easy to get a job there? Is it a suitable place to bring up a family? Obviously, that ratio is challenging for a lot of Australians to participate in the real estate economy. And really, you just have to link the two together. Population growth took off in the 90s through skilled migration, a policy created back then. And that policy's never changed. It hasn't changed since the 1990s. So that policy is effectively a policy of Treasury. Today, you need around 230,000 new migrants to come to the country to basically not have any form of recession. Now, you think about it, really, since the 1990s, 1989, there was a recession. There hasn't been a recession. There was a blip in COVID, which was more of an government-induced recession for, while everyone was on JobKeeper. But Australia has not actually had a recession because of population growth. And so the population growth, you bring a minimum of 230,000 people to Australia, you basically stimulate the services economy in Australia. You keep everyone in work. And so, of course, 230,000 people is the minimum, but we tend to beat that minimum every single year with the last data from 2023 to 2024 September, 480,000 people. So twice the amount that the government needs to economically stimulate the system, if you like. So we can see a direct correlation between more people coming to Australia and more people being born in Australia and less deaths in Australia to the wages versus house price ratio, income versus house price ratio. And so we're at a point right now where things are rather, pricey compared to what we earn, Now, we're going through a bit of a rate cut cycle at the moment. And when rates get cut, property values go up. Every sort of 0.25% rate cut, you're going to see a correlation of 2.5% capital growth. Every 1% rate cut will equal 10% capital growth. And there are more rate cuts on the cards. And the prediction from a lot of studies from economists predict that there will be several rate cuts, and it could push up property values by another sort of 12% by the time those rate cuts finish. And so, that would take a Sydney median house price from 1.691 million today to 1.894 million. A Melbourne median house price from 1,035,000 to well over 1.160 million. Brisbane, 1,022,000 to 1,100,000 and 144,000. Adelaide, 1 million to 1.12 million. Canberra, 1,049,000 today to 1,174,000. What you can see from that, we're already over the median of $1 million in basically all the major areas. And so that's pretty profound. And of course, what that's going to do is certainly make it even more unaffordable. We might go to 16 times your income to own a property. Now, I've done a previous podcast on this, the cloud pivot strategy of just burning the ship down and just pricing out property investors. And I really feel the demand wave coming through the system next is potentially going to do that. It's going to make it pretty unaffordable to buy that second or third property if you don't, have the right team. But the rate cuts are coming, and the Prime Minister has taken a policy which was meant to begin in June 2026 and brought it forward to October 2025. And really potentially brought it forward to, make sure that first home owners beat the rate cut cycle, which is going to push property values up. But what's going to happen is there's a huge wave of 100,000 spots available to buy your first home using a 5% deposit guarantee, a 5% deposit guarantee. And again, that means, the $1 million property for a first homeowner, you just need sort of 50 grand and you're away. Now, of course, a lot of people don't even have 50 grand, but a lot of people do. A lot of parents would say to their child right now, I can give you $30,000. Go find a $600,000 property. That will be real. People will realize that this is a big opportunity to get into the marketplace. And again, like families will be like, there's baby boomers with a bucket load of cash. They'll be like, geez, this is a good opportunity to set my child up with a stepping stone for them. And they're not stupid. Economically, it's a really good time to get your child into the marketplace because of the 5% kind of consideration. And again, if you've got children and you're like, well, geez, I've got to give this half-wit $100,000 to kick off getting them into their own home in normal times, and all of a sudden it becomes 30,000 or 40,000 or 50,000, you're like, this is a half-price sale to get my half-wit son out of the house and into their own. And so you'll be encouraging your children to do this. And so there's a $10 billion housing fund kind of set up to, push this through. And it's going to mean that properties which sit under the price limit for the scheme will be in hot demand because of just how many extra buyers are coming to marketplace. And again, most property investors shop at the bottom of the market price-wise. They don't spend $1.9 million. They spend, $600,000 or $700,000. Well, if the first home buyer market is also shopping there on lower deposits and easier funding, they're going to take the stock and it's going to push the prices up. Now, we've got history of this happening before. It's been sort of 3 economic home buying boosts over the last 25 years. There was one in effectively 2003. It was a first homeowner grant. I think the Howard government really pushed it, and 2002, 2003, and the amount of home loans of first home buyers getting into the market really surged. You can see from ex-home loan data for first home buyers. In 2009, they did something very similar after the GFC to stimulate the economy again, and they sort of created another home buying boost, and first homeowners were, the loans went ballistic. Now, if you track the average of sort of first home buying loans, it's typically about, in numerical terms, around 9,000 loans for the year. And in 2009, it was 16,000. With Home Builder in 2021, it was also 16,000 loans. So again, like 100,000 places, we know that getting another 16,000 first home buyers in the market in 1 year or over 2 years. And you can see from the data that 16,000 was followed by a 15,000, was followed by a 14,000 over effectively a 3-year period through Home Builder. And when you remember Home Builder, we probably can't remember what happened in 2009, but we remember Home Builder. It was basically electric to the real estate market. Created inflation, it created competition, and created capital growth. So we've got a huge population growth rate, particularly in Queensland, Western Australia, and the Queensland. New South Wales not too far behind. And then we've got the principle of affordability. We know that population reduces affordability. We know rates are getting cut. And we also know there's a huge wave of first homeowner demand coming through the system. And of course, if we go to really analyzing the property cycle as it stands, we can see from the first rate cut that has already unfolded, the capital growth in all capital cities is now in positive territory. The real estate market's going up everywhere. There's not one place that's not going up. And interesting enough, places which were going down, such as Melbourne prior to the rate hike, are now going up. And that's just the reality of the game. And of course, we can track using economic data from sources that past house price growth after 2 years after rate cuts have begun has been huge. 1984, 6%, 1988, 60%, 2003, 32%, 2013, 13%, 2021, 2 years after that, 27%. The market had grown by. So we know rate cuts lead to growth, and we know that really the other interesting dynamic coming out of the cycle itself is, despite going through quite a long period of much higher rates, the mortgage arrears rate is very, very low, very low. Very low. And so people have survived the mortgage cliff. People have survived the mortgage hikes. And I'm sure there's a sense of relief through those people with real estate. It's starting to get easier for them. And of course, if we look at where the cycle is really interesting at the moment, you can see, based on the concept of price to rent ratio, where historically properties are overpriced or underpriced. And you can see, particularly with Melbourne and Perth, there's a real underpricing in both those markets still, particularly Melbourne apartments. Wow, it's certainly an undervalued economic concept at the moment, as well as Melbourne houses, really. By way of example, is Sydney overpriced or underpriced in housing? Well, according to this AMP REA data, It is. It's 41% overpriced in housing. Is it overpriced in a unit, Sydney? No, it's at parity. It's good value in the unit market in Sydney. Is Melbourne housing overpriced? Well, no, not really. It's fairly well at parity. Is Melbourne units overpriced or underpriced? Well, it's underpriced. It's sort of around 11% underpriced. And same with Perth. And so some interesting data coming out on really where the best value is in the marketplace. And of course, the data itself around the cycle and the economic specifics in the cycle leads us up to where are we at with supply? How long does it take to build real estate? It's an interesting question because to build an apartment has blown out to 2.8 years, effectively almost 3 years to build an apartment. Same apartment from a productivity perspective took in 2013 1.7 years to build. Now it's 2.8. Interesting enough, a townhome has in 2013 took 1 year to build. Today it's 1.3 years. A house going from 7 months to build to 13 months. And so our productivity in building has fallen behind. We really have created a skilled migration system, but for some reason forgot to bring the skill of building to build enough homes for the people moving to Australia, and of course the people being born here, and the lack of deaths of people. So we are not productive. We are not productive. And Australian builders are some of the highest paid in the world, but the least productive. And so it's a real problem for the marketplace to resupply itself. And if we look at home construction versus demand, we can see that dwelling completions sits around 190,000 and underlying demand for real estate is certainly at that point, but we are undersupplied by a long shot. We just can't build to make up what we haven't built in the past. And so it's left us in a position where we're in a big undersupply at the moment. So you put all that together as a bit of a framework. You go, well, the population's soaring. The government is now seeing rate cuts earmarked for the economy. They're rushing in first home buyers before those rate cuts basically take effect. They have changed the June 2026 start to October 2025. That's going to push a lot of people into the marketplace. That's going to create a wave of interest in real estate. And of course, from a capital growth cycle perspective, that's going to create capital growth, which is already underway because of the rate cuts. And then we'll look back in 2028. What did the rate cuts plus the extra demand do from first home buyers to the marketplace? Well, I don't think I'll be looking back in 2028 going, the real estate market went back in 2026 and 2027 by 10%. I don't know. Do you? I'd love to understand the economics behind that. If you do, I would love to understand the data. I would love to understand your perspective. If you think the real estate market is going to go back 10, 15, 20% in the next 2 years. It just doesn't seem possible. It just does not seem possible. There's no low arrears. There's no crashing economy. There's still pockets of good price to rent ratio. And really, the principle of demand is we're just not building this stuff fast enough and in enough volume to create an oversupply. So you put all that together and you go, well, what next for the real estate market? You have to say there's capital growth coming. The next wave is upon us. So whether you like it or not, whether you're a bit of a cloud pivot, I don't know, tin foil hat person like me, that it's all designed to eradicate property investors. Well, yeah, maybe not. Maybe it's just about helping people get ahead in life. But tell you what, it's going to get pretty tricky if you don't get invested. The uninvested will miss another wave, and that's just a decision you have to make. All right, folks, that's it from me. I'll talk again soon. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.